What led you to build such a diversified investment approach?
Well, it didn't start diversified. I've always been very focused on whatever I'm doing, but I started out as a residential loan officer. This is when I was 22 and was a recent dropout of college. I was going to finish up, but ended up just going and starting in the mortgage business. Um, and I did that. I learned the business for about a year, and then I got out into origination where I was commission based, and it was great. I mean, I lived, breathed, and slept mortgages, and it's all I focused on, and I started making good money and started buying some rental properties in the Northern Virginia area, and pretty soon realized that I didn't like being a landlord. I didn't like doing the
Yeah.
the lending stuff. I felt like a hamster on a wheel where there was no wealth creation. I was just a high paid W-2 commission employee at the end of the day. And it was nice that I got to set my own hours and stuff like that. But it just wasn't. I definitely didn't see myself doing it long term. So at the end of 2019, I let my licenses expire, and me and a me and a partner, we actually started a house flipping company.
Where are smart investors putting money to work right now? That's the biggest question. With higher interest rates, shifting valuations, and uncertainty across the market, finding the right opportunity isn't always obvious. Today's guest has invested across lending, multifamily, hospitality notes, and public real estate, giving him a unique perspective on where opportunities may be emerging in today's market. I'm your host, Vinki Loomba, and our guest for today is Will Harvey, founder and principal of Harvey Capital. Will invests across multiple real estate sectors and specializes in identifying opportunities where public and private markets become disconnected. Today, we'll be discussing where smart real estate investors are finding opportunities in 2026. Well, welcome to the Wealth Vibe Show.
Hey, thanks so much for having me on. It's an honor to be here.
Thanks. I'm super happy to have you with me today. So, Will, before we talk about today's market, let's start with your journey. You have invested across lending, multifamily, hospitality, multiple sectors, right? What led you to build such a diversified investment approach?
Well, it didn't start diversified. I've always been very focused on whatever I'm doing, but I started out as a residential loan officer. This is when I was 22 and was a recent dropout of college. I was going to finish up, but ended up just going and starting in the mortgage business. Um, and I did that. I learned the business for about a year, and then I got out into origination where I was commission based, and it was great. I mean, I lived, breathed, and slept mortgages, and it's all I focused on, and I started making good money and started buying some rental properties in the Northern Virginia area, and pretty soon realized that I didn't like being a landlord. I didn't like doing the
Yeah.
the lending stuff. I felt like a hamster on a wheel where there was no wealth creation. I was just a high paid W-2 commission employee at the end of the day. And it was nice that I got to set my own hours and stuff like that. But it just wasn't. I definitely didn't see myself doing it long term. So at the end of 2019, I let my licenses expire, and me and a me and a partner, we actually started a house flipping company. So I did that for a few years, and towards the tail end of that, I bought a couple properties um, with a partner and then some silent partners, some limited partners. We bought a wedding venue and a hotel, so we syndicated a few deals there. They're on the smaller end of things, but those we still own today. And while I was doing all that, I just realized over time that I much prefer the finance side of things as opposed to being on the operator side of things. So in 2023, after having rental properties and doing a bunch of house flips, and I invested in a handful of multifamily and mobile home park syndications, both as a GP and LP, mainly as an LP. Um,
Mhm.
but all the while, like I said, I just liked being on the finance side of things. And so in 2023, I started my own fund, and I've pretty much been a fund manager, and that's what I've focused on since then. And now my main focus is on hard money lending. So in my first fund, we started doing some hard money loans just with cash that was sitting on the sidelines. And over time, I realized that, hey, these are great returns on capital, and this has been a great asset for the fund. So last year in 2025, I decided to start a dedicated fund specific to hard money lending, and that's what I do now, and that's my main focus.
Wow, quite a journey. So let's break it down
Yeah,
a little bit. Let's start with the first one. When you said you um, started with owning some properties, right? Some
that's
rental
right.
properties that you bought, but then you thought there was no wealth creation. Why did you think there was no wealth creation by owning your own properties?
Well, there's definitely wealth creation in owning properties. When I was saying no wealth creation, I meant in regards to being in the mortgage business and being a loan officer. So I was just a W-2 employee, made good money, but that was where I felt like a hamster on a wheel, where there was no wealth creation. But owning properties is absolutely a way to build wealth. But why I didn't like it is because
Because you
all
were
the
doing it
headaches.
yourself and the
Yeah,
headaches,
exactly.
the tenants, toilets, termites, you didn't want to deal with that, right?
Exactly. And the
Effort
cash
was more
flow.
than the money. Mhm.
Yeah, bingo, exactly. So I knew that there were better ways to build wealth and to scale quicker.
So then you moved on to flipping houses with your friend, right?
That's right.
So what was the mindset there? It's like, okay, I tried owning my own properties, the rental properties, dealt with the tenant, toilet, termites, So let me move that away from that model. Let me go into flipping now.
Yeah,
So take us a little bit deeper on that journey and how does
sure.
that work, flipping for
Yeah,
our
so
audience?
obviously house flipping is not, it's a way to generate cash, but it's not a way to generate wealth. So
Mhm.
my strategy there was I would flip houses, and let's say that, I own 50% of the company. So let's say that we did a flip and made 70,000. So my cut would be 35 grand. I would
Mhm.
take that and I would deploy it into, I would take a little bit to live on, but I didn't need much, and I had some rentals and other income. So I was pretty much able to deploy whatever I was making from flipping houses into um, multifamily syndications.
Because
And
deal.
by doing it
Smart.
that by doing that, I would get a lot of bonus depreciation because I'm considered a full-time real estate investor in the eyes of the IRS. So, I would get a lot of year one bonus depreciation on the K1, and that would offset the active income that I was getting from flipping houses. So it was a great way to build wealth by investing in, good multifamily assets, and also drive down the amount of money that I have to pay to Uncle Sam every year. So that was a cool strategy. And
Yes.
the reason I liked flipping houses is, I mean, you don't have to answer to anyone. You're the one in control. You don't have clients bugging you. You know, when I was a loan officer, I had people calling me at 10 p.m. and realtors and all that. There's no one bugging you. You're the one that gets to bug everyone else. You get to, you know, crack the whip on the
The boss.
contractors and make sure that everything stays on schedule. And there's really no one to answer to. And it's also very, I I think it's one of the, in real estate, one of the highest leverage things you can do. And what I mean by leverage is just the return on time and the return on, as long as you're smart and you buy them
Mhm.
right, I mean, you can make crazy money in very, very short periods of time as long as you're disciplined and you're efficient and you know what you're doing. I mean, there's some flips where there's one in particular where from cradle to grave, I think it was 38 days. We bought it and then sold it 38 days later, and we made $150,000. And it wasn't a crazy, we paid 400,000 for it. So it wasn't like we were flipping a $2 million property. We were flipping a, you know, a relatively small, for Northern Virginia at least, a relatively lower price point property, and we just were efficient, and the market, this is 2021, so the market definitely helped us out. But you know, we have a few other stories like that where we just made crazy money, where if you look at our hourly rate, you know, it was very, very high on those deals. And I think that, you know, that was a great way to stack some cash and be allowed to, you know, that just propelled me into everything else where you know, I now have cash to invest in other things that build wealth.
Wow, I love that. And you said, if you are smart enough. So, what does that smart look like for the average person who's looking to start? Maybe thinking like you, maybe I should buy some rental properties, maybe I should flip some house, or maybe I wanted to invest in a syndication. Maybe I wanted to invest in, Will's fund. So, but they are just sitting on the sidelines, not taking the action. So, what is that smart that you said? What piece of being smart is going to make them take that action?
Yeah, it's definitely not an intellectual smart. I can
Right.
promise you that because I'm living proof of that it's not intellectual smart. I think it's just, I don't know, being scrappy, being able to figure out where I think that what's kept me out of trouble. I've made every mistake in the book that you can make, but what's really kept me out of trouble is you know, being disciplined on the price that we pay for things. So as an investor, whether that's investing in real estate or any other asset, you got to buy it right, and you have to pay a price that allows you to make mistakes. You know, if you're buying something at the top of the market and you're leaving yourself no margin of safety, you know, no wiggle room, then any hiccup that comes along is usually gonna lead to a bad outcome for you. Whereas if you buy a property at a deep discount, if you're patient enough to wait for something and buy it at a discount, um, if you screw something else up down the line on the property, you make a mistake, you can usually absorb that because you bought the property so well. So I think that that's where, when I say smart, that's what I mean. You got to be patient. You got to be, you got to be persistent and just keep turning over rocks. You know, for us, we had to look at it and make offers on a lot of properties before we ended up getting one. So, um, you know, I think that's what I mean by being smart. And then as far as taking your other part of the question about taking action, yeah, I think you have to go out and you have to make mistakes, and you have to start somewhere. You know, you see people at real estate meetup groups that go there for years and they're constantly taking notes and they never do anything. And
I
you know,
know.
you don't want to be that person. You got to go out and you got to start somewhere. You got to pull the trigger. And you know, there's a quote I love. It's on my computer here. It's action produces information. So
That's
I love that, and I really try to apply that when I don't know when I want to try something and want, whether it's a new marketing thing or a new strategy or whatever, I think that just starting and going and just getting into it, you might make mistakes and you might learn that something was not the right way to go about it, but that's information, that's data, and that's valuable. And the only way you get that is by getting into it and rolling up your sleeves and starting. So I think that can be applied to a lot.
That's true. And that's called curiosity, right? Being curious about something. Let me figure it out.
Exactly.
And then you said very well, mistakes, make your mistakes and learn from it. And then I would like you to share with us some of your mistakes and what did you learn? Because a lot of people, I think they are afraid of making mistake. It's not like that
Yeah.
they are afraid of making mistakes. They are afraid of it that, few years down the road, when they go back and then look back, they might think, oh my God, they're judging themselves basically, not anybody else. So
Yeah.
they rather not do it and learn everything before they take an action. You know what I'm saying?
Yeah.
Like,
Yeah,
I need to figure
absolutely.
out 100% before I take an action. And that never happens. And that's the reason
That's
they're
right.
sitting on the sidelines all the time. So I wanted to learn from your experience, what mistakes did you make and how did you correct yourself? And how can you, teach our listeners something what you learned?
Yeah, I think that there's a ton of mistakes I've made. I've on our first flip we over improved it and we missed when the market was good and then the market went down and we ended up making about half of what we thought we would make, and it was still a great outcome. We made almost 50,000. It was a $170,000 purchase and we put about, I want to say, 50 or 60 into it. So it was a fine, it was a great turnout, but we just made a lot of mistakes. But that illustrates how buying the property right can absorb all those mistakes. Had we paid a higher price or not been as disciplined on the price that we bought it for, then maybe that would have hurt us more. Another mistake that I made was in early 2022. Me and some partners, I just didn't have a ton going on at the time, and that has hurt me in the past. I think, and Warren Buffett talks about that a lot in his shareholder letters, where if you don't have any deals going on, then a lot of times you'll kind of talk yourself into doing a deal that you probably wouldn't have if you had a lot more opportunities to look at. And that happened to me. And ever since then, I've learned from that and been patient. So I bought a property with some partners and we bought at the very beginning of 2022, right before rates started going up and before the market changed. And we, in hindsight, overpaid for this property that was outside of our normal buy box. It was an $800,000 house in Northern Virginia, and usually we're buying them for, half that. So we were just way outside our typical buy box, and I didn't have a lot going on, so I kind of talked myself into doing this deal. The house was funky, and I didn't really have a good plan for it. We were thinking about Airbnb-ing it, but also flipping it, and it was just not a good
For me.
it's just not a good plan. And yeah, and long story short, we kind of fumbled around with it, trying to figure out what to do with it for 18 months before we just dumped it, and we lost about $70,000 on it. So, that was a $70,000 lesson, and I haven't made that mistake since then. And I hope, as long as I live, that every time I, start to get bored and start thinking about some stupid thing to do, that I think about that and
But
I don't
anyhow.
make that mistake again. you know
But there was no way that you could have pivoted, Sometimes pivot works too, and I have seen that in my own experience too. A lot of operators, because I come from the syndication world, so a lot of operators, they're like very linear thinking.
Yeah, sure. I mean, yeah, and I've had other properties where we've pivoted. With this one though, it just wasn't. I mean, losing $70,000 was painful. It was not fun.
Mhm.
But in the
A
grand
lesson learned.
scheme, it wasn't a crazy amount, and the sanity that it bought me back by not having to deal with that property anymore was worth far more than that money that was lost. So, I was just tired of trying to figure out what to do with it, and just felt that cutting bait and moving on and figuring out our next move was the better way to go. Back to Warren Buffett, he has a good quote that's if you find yourself in a constantly leaking vessel, energy spent finding a new vessel is usually
Cost you a lot
better
more.
than
Yeah.
better than trying to plug the holes in the vessel you're in. And I felt that. I felt like that house, it was just weird. It was not a good layout. We were trying to rent it and do all kinds of different variations as a short-term rental, and none of it really worked. And it was just a leaking vessel. And I was just tired of trying to fix it and plug holes. And so we just dumped it and moved on. And here we are.
Yeah, good for you. It's always good idea to, cut your losses sometime at some point, as needed. So, but you have, done so much. The house flipping, the house rentals, and then syndication, or your fund manager. You've been in several sectors, I think, or several asset classes as well. So, what has that taught you about wealth building that than the average investors who just focus on only one asset class and might miss some other opportunities out there?
Yeah, well, it was never by design to do all these different things. And for the past few years, since, early 24 really, my strategy has been pretty set in stone. And I've been there's always tweaks and things you change here and there, but it's really been the same strategy since then. And it just took me a while to almost 9 years to figure it out. And I was in my early 20s when I got in the mortgage business and bought my first house in 2016, and just kind of progressed and like you said, owned some rentals, then did some house flips, some syndications, and I just realized through my own experience what I like, what I don't like, and there was nobody that could have told me any of that. I had to figure that out on my own. And uh, after almost 10 years now, I know what I like and I know what I don't like. And, I'm not going to own Lord willing, I'm not going to own a rental property ever again. It's just not my thing. I don't enjoy it. I don't like dealing with tenants and all those headaches. But other guys love it. We have a lend or a borrower that we do a lot of loans for, and he has 200 something units. Most of them are just single family houses. And he just loves it. He's got like a 5-person team, and they do all the management in-house. And to me, it just seems like pure chaos. But for him, he loves it.
Okay.
It's yeah, he probably looks at what I do, where I love being behind my computer and just going through financial models. I was gonna say going in Excel, but now I really just use Claude. I don't even go in Excel anymore.
I know life is much
You know,
easier now.
yeah, but
Mm.
that's what I love. That's therapeutic for me. But for someone like him who needs that action and needs that, he has a contracting background. He loves swinging hammers and doing all that, and that's just not me. I didn't like any bit of that. So, I think everybody has different skills and strengths and weaknesses and different temperaments, and you just got to figure out what yours is, and then what kind of what fulfills you.
Yeah, you said it very well, actually, because everybody has a different journey and everybody has a different set of glasses that they look at things. So nobody can live somebody else's life. And if you try to live somebody else's life, you're never going to be successful.
Yeah, that's
Everybody
right.
learns from their own experiences because they're looking at life from their own experiences. And that's what develops their likes and dislikes and, their strengths and weaknesses.
Yeah,
So until
that's
unless you do it
exactly
yourself, you
right.
don't know your strengths. And once you know your strengths, there's no looking back. And that's
That's
what you
it.
did. And thank you for sharing that. So many of our listeners are actually busy professionals or business owners. So when you look at today's market, what are you seeing that they should be paying attention to right now?
Oh man, there's a lot of things. I think that
Mhm,
it's very interesting the what's going on with private credit. That's something I've followed pretty closely, and just seeing all the defaults and all the loans that have gone PIK, payment in kind, where they're not really uh, you know, nobody wants to default them
mhm,
and go collect. They want to extend and pretend and do all that. So there's a lot of funkiness in the private credit world. I think there's a lot going on. Like I said, I have a fund, and we invest in through public markets. We invest in real estate companies, primarily REITs and things like that. And looking at a lot of REITs and the public filings that companies have to do, there's a lot of there's a lot of debt that is coming due in the next few years. And you hear
mhm,
people talk about it and you read headlines, but once going through hundreds and hundreds of these company reports, you realize that this is a real thing, and there's a lot of there's something brewing under the surface, and in commercial real estate, and I don't really know what's going to happen, but I'm definitely keeping an eye on it, and I think that for a lot of people, there will be a lot of pain in the coming years, and then for others there will be opportunity, and
that's so true.
uh,
Mhm.
I hope I'm more so on the opportunity side.
That's true because I think in every market there's a different set of players. So it's not like that the market is gonna collapse completely,
Right.
but this market is for a different set of players. So you
Yeah.
also mentioned, public companies versus private companies. Excuse my voice. That you invest in REITs as well as you mentioned you invest in syndications too. So I think this is the perfect time right now for us if you can share what the difference is between the two and what your experience is like in both sectors.
Yeah. So I like public investing a lot more than I do private. And the reason is primarily that there's simply just so much more deal flow. So if you're somebody who has the time to sift through tons and tons and tons of annual reports, 10Ks, 10Qs, and look at all these different public companies, and you know try to find mispriced things, then the public markets are just going to give you way more opportunities. I have a handful of guys that I've invested with in their private syndications, and there's just not, maybe I'll get a deal once a month, maybe two deals a month, but it's not, what's available in the public markets is orders and orders of magnitude larger than what I have access to in the private markets. So just looking there is just I'm kind of a math and statistics guy, and it's sort of like if I'm looking at 500 opportunities in the public markets versus three opportunities in the private markets, there's a higher likelihood that I find a better deal. If I can only make one investment, I'm probably going to find a better opportunity in the public markets, because there's just so many more things to look at. So I'll give you an example. We made some money a couple years ago on, this was really our first one, and it's what got me into this strategy in the first place. It was a liquidating trust that was formed in connection with J.C. Penney's bankruptcy filing. So JCPenney filed bankruptcy in late 2020, and these two big mall operators, Simon and Brookfield, they bought them in a joint venture. So they bought JCPenney out of bankruptcy. And what they did was they separated JCPenney's operating business from their real estate holdings. And they took the real estate holdings and they spun it into a liquidating trust and gave those shares to all the various creditors that were owed money in the bankruptcy. So those creditors didn't want those shares, so they just dumped them. And the price had gone down. It was a couple years and it had gone down substantially. And we found it when it was just trading at a crazy low price where they had the summary of this was that it was 130 properties, no debt. They had zero debt. So 130 properties that were leased to JCPenney, the new well-capitalized operating
Locations.
company, on a 20-year absolute triple net master lease.
Mhm.
And we were able to buy it at an implied cap rate of about 14%, which is just insane. And they
It
were
is.
turning around. Yeah, and they were turning around. It was a liquidating trust, so they were selling properties on the private market. So, and then they would distribute the proceeds to the shareholders. And so we bought at an implied cap rate of 14%, and they were turning around and selling properties at 7% cap rates. So it was basically just an arbitrage between public and private real estate valuations, where we bought at a really really low public valuation, and then they were turning around and selling them for pretty much double what we paid. And it was just a phenomenal. We put a lot of our funds money into it, and it did really well.
Wow, that's a good one. But you do invest in the private companies too, right? You mentioned earlier that you are a LP in some of the syndicated deals and you're a
Yes.
fund manager too. So what is the major difference that you see? You talk about the deals, but how about the returns?
Well, if you're just looking at it like, hey, I'm gonna go out and I'm gonna just passively invest. I don't want to do much work. I have a busy full-time job, or I'm a doctor or something like that. And I don't have time to go out and analyze all these deals myself and actively do this. Then you probably will get higher returns investing in private deals. REITs, the big REITs pay very, very low dividends and very, very small dividends, usually in the 3 to 4% range, and so the private deals are typically modeled to do better. And my experience has been that they do better. Now, however, if you're hunting for mispriced things like that J.C. Penney deal I just mentioned, then that completely changes the calculus. I mean, our fund did our annualized return on that was we were in it about a year, and we got, just from cradle to grave, our annualized return, or IRR, it was very close to 50%. And it actually underperformed what I thought it was going to do. So 50% was a 50% return on our money was not, that was lower than what I thought it was going to be. So, but that took a lot of time, and that took a lot of research, and that took a lot of, a lot of diligence. I was doing this, I'm full time doing this. So that's why I say that an apples to apples comparison would more so be someone that's just looking to passively, put 50 grand in a bunch of REITs, or 50 grand in private deals. I think you're going to get a better return going private,
I'm going
as
private.
long as you
Yeah.
invest with good operators. If you invest with ones that, don't make good decisions, and, get, yeah, we've seen a lot of, what's it called? floating rate debt. We've seen a lot of floating rate debt have
A lot more
problems.
risk as well. Risk too, a
Yeah.
little bit
Yeah,
higher in
exactly.
the private, but more the risk, more the money, we all know
Yeah,
that. But
exactly.
but let me ask you this question. What was the timeline for your GC Penny deal for a 50% return on that
It
one
was actually about a year. It was
within a
about a
year?
year. Yeah, we bought it.
So you grew up to 50% what? Annualized return?
Yeah, based on the capital that we put in. Yeah, it was about a year and we yeah, we made a chunk of it from just liquidation proceeds when they would sell properties. And then by the time we ended up they ended up announcing a deal where they were going to sell the entire they sold about eight or nine while we owned it,
Hmm.
eight or nine properties. And then they announced that they were going to sell the remaining 120 or so in a big deal to this private equity buyer. And once they announced that, the upside was pretty capped. We knew what it was going to be, and we had held it over a year, so we were in a long-term capital gains situation. So we just sold it. And actually the deal fell apart. So people can still go out and buy that today.
Oh, really? So, but where do you go find these kind of deals, first of all?
You go in your Fidelity account and go, it just trades over the counter. I think the ticker is CP, I don't forget what it is. It's like five letters, but it's Copper Properties Liquidating Trust. And it's a really interesting one. And there's more like that out there. We've made some money on some other ones too, and there's some unique, I would call them situations in the public markets that get overlooked, especially in the smaller market cap space. Everyone's focused on SpaceX and Nvidia and all those popular things. And sometimes these smaller real estate, asset heavy companies are just the ugly ducklings. And I think that's where you can find opportunity.
Yeah, but this is right now, right, when they're retrading and the Fidelity. But how did you find the deal first time? Or is there any website or any
Oh,
resources that you
yeah,
use?
I was just using a screener, a stock screener. I think I was using Koyfin. There's a million out there. People can, use free ones, and there's all kinds of stuff out there. And especially with AI, I mean, AI is unbelievable at, giving you a first run at these companies and kind of telling you just summarizing, an opportunity that you might find. And yeah, so yeah, I just used a screener and found that one. And yeah, pretty much read every filing of theirs and got my head wrapped around it. And it was just a very compelling opportunity.
So you earlier you said you use Claude for your underwriting models. Share with us how are you using that?
And I use Claude for pretty much everything.
Everything. Super
Yeah.
user.
Oh, for sure. Yeah, I have it. Yeah, me and my operations lead in the lending company. I mean, we are just using it. We will communicate a lot of times through markdown files that we just send to each other, and we just copy and paste it into Claude. And like we're not even really, it's more so that our Claudes are talking to each other. And it's just allowed us to move so fast. And when we're underwriting someone's file, like if we have someone that is looking to get a loan from us, it just makes it so fast, so efficient, and the quality of the work. As long as you set it up correctly, we've set up different skills and different we I have it. It operates on my computer's terminal, so it can do a lot. And I yeah, we'll have it ingest. Like for instance, if someone is looking to get a loan from us, they're a real estate investor and they're looking to buy a property to flip or they have something under contract, I'll have them send me as much info as they can. I tell them, look, send me the contract, send me your underwriting analysis, send me PDFs, send me everything. Send me, screenshots of scribbles from your when you're budgeting it, and send me everything. And I dump it all into Claude, into this and I run this skill, and it comes out with it basically puts everything together in a neat little credit memo for me, and then I make a decision from there. So it takes what would have taken hours for a human to do, and it compresses it into minutes, and then I can make a decision based on that.
That's good. Life is good, huh? Oh my God, we are way over time. I didn't
Yeah.
even realize such a great information. So I'm gonna ask you one last question, then we'll move on to our rapid fire. So looking ahead over the next 12 to 24 months, where do you believe some of the best risk-adjusted opportunities may emerge?
Well, I'm biased, so of course I think it's in hard money lending.
There's no dry powder out there. Yes, you're gonna rock it for sure.
Yeah, no, I like lending. It's where I have a lot of my net worth, and I like being, back. They're all the notes are all backed by first lien deeds of trust, and our returns when annualized are pushing 20%. So because we collect fees and points, and they're higher interest rates. So I like that. I like syndications. I think that guys that, I don't really do it as much because I'm more, if I'm going to invest in something like that, I'd rather, I'll look in the public markets because I do this actively and have the time to really sit down and analyze things, and just I have endless curiosity to go through a lot of deals. But um, I think that syndications are phenomenal, especially for the operators who are experienced, well capitalized, who are able to go out and like I was saying, I think that there's distress out there. I know there's distress out there now, and I think there will be more in the coming years. And I think the guys that are patient and have the ability to move when an opportunity like that comes up, I think they will be able to buy things at terrific prices. And if you're a limited partner and you don't want to be doing all that heavy lifting yourself and would rather invest alongside someone who you trust to manage all that, I think that finding those guys right now and starting to form relationships with them so that when a deal comes along, you can pull the trigger. I think that's a very smart thing to do.
That's true. I agree on that. So let's have some fun with our rapid fire round. I'm going to ask you five questions. You're going to answer it in one word or one sentence only. So no overthinking, spontaneous answer, whatever comes to your mind first. Are you ready?
Yep.
What's one book every investor should read?
Think they should read Warren Buffett's shareholder letters.
That's a good one, actually. Um, do you have any morning or evening routine that you can share with us?
Yeah, in the morning I wake up early about 5:15, 5:30. I generally read the Bible, pray. I'm a follower of Jesus, so I try to really center my mind and get in the Word, and then I start my day. And in the evening it's time with family, wind down, read, and then bed.
Nice. One word that describes a great investment opportunity.
Mispriced.
What's one mistake you never want to repeat?
Overpaying.
What is your wealth vibe?
My wealth vibe is to, I would say, to get rich or get wealthy slow. Don't focus on the fast, get rich quick things, all the drop shipping and all those dumb courses that people talk about. Focus on what you can do to just accumulate over time and compound, and I think that that's the way to really build wealth.
So, Will, for those who would like to learn more about you or Harvey Capital, how can they connect with you?
They can go to our website, harvey-capital.com, or just shoot me an email. It's will@harvey-capital.com.
Well, thank you for joining us and sharing your experience. I think this was a really good show, and we learned a lot from you, from your experiences. And one key takeaway for today's conversation is wealth isn't built by predicting markets. It's built by making disciplined decisions over and over again, like we saw Will did. Whether you're investing in multifamily notes, lending, or in public markets, the goal is the same. Understand the risk, know what you're buying, and allocate capital where value exceeds price. So, everyone listening today, thank you for spending time with us. And if you found this conversation valuable, please be sure to subscribe, leave a review, or share this episode with someone who benefit from it. So, until next time, stay inspired, stay intentional, and keep building your wealth pie.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.